Welcome. I'm Angelo Robles, founder and CEO at Family Office Association. Thank you all for watching this video today. We're more known for our research, our content, and our programming dedicated to our core constituency, being incredibly wealthy families and their family offices. But I wanted to share my opinions, and that's all they are, my opinions. And I'm not a financial advisor. I run a membership organization dedicated to highly wealthy families around the world. But nonetheless, I get some intriguing insights from them and their amazing successes to leading experts around the world. And I wanted to share a little bit of my personal commentary of investing advice during challenging times. And again, it comes from not being a professional. And I don't know, following investment advice from someone wearing a yellow double-breasted sports jacket may not be the best move, but we'll give it a shot. We're all facing the challenges of the coronavirus and the impact on the economy and its effect on us. And none of us know, is the market at a low? We're probably still relatively early stage, but there are some very smart people that believe perhaps this is already priced into the market and we are low or at the lowest. We don't have a crystal ball, so no one knows the answer to that question. We can make an argument if you liked certain public companies' investments beforehand and you feel their financials hold up for the most part during this crisis, you get an opportunity to buy, so to speak, at a discount. But I digress a little bit. The core part of what I'm going to talk about is, do you invest or do you stay on the sidelines, for lack of a better word? Well, as many things in life, there's no easy answer. It's not a yes or a no. The most honest answer is, it depends. What are your goals? How much is needed to achieve those goals? And most professionals may recommend a 4% distribution of your capital subject to inflation for retirement. So it's relatively easy math in terms of figuring that out, what it could be. What is your timeline? What is your liquidity needs? Your age, your health? There's so many different factors that come into play, but these are all things that need to be considered. What do the incredibly wealthy do? They develop an investment policy statement, basically a framework of their goals and a process to get to their outcome in terms of how they're going to reach that goals and what parameters they're allowing from an investing perspective to get there. From there, they develop an asset allocation plan. What assets are they going to invest in? Cash, fixed income, bonds, public securities, non-public, private companies, real estate, etc. I could go on. They develop usually a diversified plan to help hedge against risk that could happen. Now, most of us per se are not going to do an investment policy statement in the true definition of creating such a document, but that doesn't mean that it's not worthy and that it's not worthy of thinking through the process. We put all this time into planning for so much in our life. What are we going to watch on TV? What vacation are we going to? Yet it's amazing how so many people don't put that same level of commitment and effort into something that is going to be important to them. What are your goals? What finances are needed to realistically achieve them? And how are you going to make that happen with discipline, patience, and time? And that's the whole thing with investing. If you're in it really for the quick buck, I think you're lucky if you make any money at it. There's incredibly smart, intelligent, highly successful people that think that they have an edge, and often they don't. Look at the professionals in hedge funds and venture capital and private equity, some of the smartest people in the world. Yet many of them can't even beat a lowly benchmark, especially net of taxes and net of fees. There are some that are going to be exceptional. There are some. They're going to be very hard to get into, by the way, unless you have a tremendous amount of money for many of them. So trying to time the market per se and trying to think that you're going to know more than the experts. I think that Warren Buffett basically has it right. For most Americans, have money in cash, a allocation probably more towards mutual funds and index fund, possibly a separately managed account for fixed income and for public equities, kind of matching the S&P, and kind of leave it alone. I know that doesn't sound too exciting. And yes, the more uber rich are going to be more active in real estate, in private companies, in earlier stage investing. Some of them will do this directly, which is challenging, but potentially possible. And some through funds, whether earlier stage companies, venture capital, more mature companies in private equity, and some may use hedge funds, which have, for the most part, gravely underperformed since the raging bull market. But now, with some of the challenges in the market and the up and down nature, it creates an opportunity for certain hedge fund managers that are very talented, good, and probably a little bit lucky in terms of getting exceptional returns, even net of their fees and taxes. So much of this depends for the typical investor. Yes, you should invest. Yes, it should be automated, probably taken from your salary and deposited it into a 401k or Roth IRA. And sometimes you're better off outside of the retirement plan relative to liquidity needs. So again, it's complex. There's no easy answer. It all depends on so many different factors. Also, we're starting to see the trend among younger people that, again, have time on their side, where if you're older and you're going to retire in 3 or 4 years, you probably can't afford, it won't be comfortable to sleep at night, to take too much risk. Because during the end of your working years, if you built up a nest egg and you have plans for that, and then you have a 40% market downturn, you are screwed. That's a really bad position. You'll probably be working for many, many, many more years, which you may not be in position to, or health-wise, or even the opportunity to. But if you're younger, you got decades on your side, depending on your goals. Now, what sometimes the incredibly wealthy do is they set different investment policy statements and allocation relative to specific core goals, because they have different time horizons, different risk tolerances. But that becomes complicated per se in terms of managing that. So for most of us, the opportunity for one core investment policy statement and allocation, although maybe not optimum, is probably going to be realistic. We can make the argument, again, like I said earlier, that the market downturn provides potential opportunities and maybe areas to keep away from. Is hospitality and airlines going to be very challenged? But are they going to get certain tax breaks and bounce back? And is this going to be all short term and get better? Again, who knows? But I would maybe look at online education, healthcare as areas that are probably going to be very strong growth markets for a long time. People who aren't sophisticated investors tend to buy on emotions. They buy high and they sell low, where people that are very successful and smart investors and disciplined and patient, they look for opportunities like this. And they don't know where the bottom is. Maybe they get in a little too early, but they know overall they're buying at a discount. They're buying low and they're selling high. But to do that, you got to have goals. You got to have discipline. You got to understand kind of why you're doing what you're doing. And do you have the wherewithal to withstand what could be some more shorter term gyrations in the market? Trends that we're seeing among younger investors. It's true. Generally, they have more of a distrust of the typical markets, of how companies are run, and not always trusting in what they deem to be the ethics, the quality, and the focus on things that are important to them, maybe climate change. So they're looking more strategically at companies or filters that believe in some of the principles and follow some of those principles that they do. And that's going to be important for them. Yes, they appear sometimes to have more money in, let's call it cash, as opposed to being invested in the market. And cryptocurrencies may be a little bit more exciting and applicable to some of them. But again, be careful of the get rich scheme. Some people may get lucky at certain strategic investments like that. But again, is this something you really do for a living? You're competing against the best of the best. There's so many of them out there. I think you're better off focusing in on the personal quality of your life, your career, your education, and your earnings, and showing the discipline to strategically invest and be patient over time. Don't buy high and sell low. Buy as low as you possibly could. Be strategic, be more of a value investor, and then as applicable to sell, hopefully high. Well, again, the man in the gold, double-breasted suit talking about investing. I don't know if my mother would have told me to believe someone like that when I was younger. But here we are in very unique times. I hope you found this video very helpful. It's always a pleasure. Stay safe. Thank you very much.